tell them I'm the truth, I think they knew it. Don't like to talk about the shit, I like to do it. So while these other hungry going through it, you see me thumbing through these hundreds, getting to it. Ain't had to tell them I'm the truth, I think they knew it. Don't like to talk about that shit, I like to do it. So while these other hungry going through it, you see me thumbing through these hundreds, getting to it.
Folgers.
The best part of waking up, the Folgers in your cup.
I'm in corporate with the Starbucks. Hey, everybody. Welcome to another episode of the MorEstate Podcast. I am the estate in this, I guess we'll call it a mutually agreed upon relationship.
Tag team champions, all that. Hello, everybody. I'm Bryant Mormon, your friendly mortgage pilot, and I am the More in this MorEstate, not to be confused with my amazing alma mater, Morehouse, because that was actually a question. A friend was like, Brian, are you the More because of Morehouse? And I'm like, it's the More is the mortgage, and and Harvey is the estate as in real estate. So I am the mortgage, he is the real estate. It's a symbiotic relationship.
And shout out to Naturally Shamir, who suggested that our name be the Mortgage Bros.
Right.
But I'm not in mortgage. I'm in real estate. So that name wouldn't ring true necessarily in the way that we're trying to make MorEstate kind of
MorEstate Bros. Bros who real estate.
Okay, we're trying way too hard.
All right. Cool.
This episode, we're going to be diving into a couple different things, but right off the top.
For the record, though, man, your line is fresh, bro.
Oh, yeah? Oh, appreciate it, man. Yeah. Appreciate it. Shout out to Centric Barbershop in Union City and my boy Ryan, Mr. Rainland, on Instagram. He recommended this spot, and so
nice.
I'm straight out the box, bro. I came straight
it's
from.
Crispy, fam. I see it. That's what's happening. Actually, shout out to my barber, Terrence, aka T, over at Barbie's Barbershop. He actually used to cut my hair at Mass Appeal. All of my Morehouse alumni I know probably remember Mass Appeal, but yeah, T used to cut my hair at Mass Appeal way back in the day. He's got, he recommended keeping a little bit on the top, I guess, so I look like an elder statesman and not like I'm 25.
Well, you do look elder, especially with that elder hat you're putting on.
Elder hat? Bro, this Eastside Golf hat is fire. What? Fam? Nah. This hat fire.
Spoken like a true grandpa. Anyhow, I wanted to, right off the top, I guess not off the top, we just talked about my lovely lines here.
Yeah, you got right off the top, Phil.
Okay. All right. It's going to be one of those shows. Okay. No, game on. By the way, shout out to Lana, Centric Barbershop out there in Union City. She got this stuff for me right before the show.
What's happening, man? What's happening?
Yeah,
Fresh for the people.
Yes, ma'am. Yes, sir. I was thinking of. Anyways, we have a question that I thought would be good that we address before we kind of get into today's episode, kind of put a bow on the last episode. This actually is from episode 3.
Right.
My Just System 23.
Okay.
I glanced at it. I wanted to make sure I got the name right.
Okay.
His comment was, if a home was purchased in 2019 or 2020, as you stated. Now, in this episode, we're talking about appreciation and assumable mortgages. So if you're unclear, hit pause, go watch episode 3 so you get some background. Come back to us now, and this will all make sense.
We might have to have Dom add that as a link at the end of this episode, a link to episode 3.
Yeah, Dom, link us, man. Link us.
Shout out to Dom.
Shout out to Dom.
Hey, man, Dom is that dude right there. That's our homie nerdy Toretto over there.
Yeah,
I'm with it.
Yeah, no, he's making us look way better than we actually are. But let's go to the remaining portion of the comment. My Just System 23. If a home was purchased in 2019 or 2020, as you stated, and it has a doable, assumable loan, most of them won't have a ton of equity unless they, I don't know who they are, paid a large down payment. He just said down, so down payment. The difference between a 3.5% loan and a 6.75% loan, let me just reset that. The difference between a 3.5% loan and a 6.5% in payment is huge and can mean a lot to a buyer. All the costs you talk about are going to be there no matter what with the purchase. So the only real cost is the equity-based down payment. For some, this is an excellent option. I know you got some stuff you wanna address directly, but let me go ahead and just give my piece on this. So yes, there are hard costs. There are going to be hard costs with any loan, with any type of loan that you assume or new loan that you open up. There are going to be hard costs. That's never going to change. Now, the difference between paying a loan at 3.5% versus paying a loan at 6.75%, like you say here in your comment, of course, there's going to be a huge difference. I mean, that's a ridiculous, almost 2 times. So really what we're talking about is you have to, as the buyer, cover any equity that is now a part of the purchase of the property you want. So what do I mean by that? You buy a house, let's say in 2019, you want to sell in 2023. When you bought the house, it was worth $100,000, just simple numbers here. This is not actual. This is just for, explanation purposes. Now, when you go to sell the home or you want to assume the loan at that home, now let's say that home is worth $150,000. So you have all of those same hard costs when it comes to acquiring the loan, right? Closing costs, any other admin costs, any type of service fees. That is all coming from the lender. Those are service fees. Those will always be there, okay? On top of that, you still have to pay that equity, that margin, right? Because as the seller, I want my equity out of the home. I'm not just going to let you take over my mortgage and I go do something else. I want my $50,000.
Oh, so you're saying if I bought a house at $200,000 and now my house is worth, let's call it $280,000 4 years later, you saying that I got to give you that $80,000 difference? Is that what you're saying?
Yes, in cash. Thank you.
I'm kidding, man.
Give me that money. No, but I mean, and then you have the pleasure of continuing the mortgage that the prior homeowner was paying. You have to pay out the equity. Now that equity, who knows? I think we even talked about it in the episode. It could be 20,000, it could be 10,000, it could be 100,000. That's why we were saying it might not be the best option, especially for first-time home buyers, but in general, it might not be the best option for a buyer that isn't like a real estate investor or somebody that has a lot of cash on hand.
Because even in our current market, home prices are still going up. You Correct. Are still, and during that 2020 to 2022 time period, depending on the area in which somebody lived, you saw appreciation, guys, anywhere from 8 to 10%. Maybe we can check with NAR and see what the actual number is, but if I remember correctly, it was between anywhere from 8 to 10%. And so if you think about 8 to 10% over, to reference what the gentleman or the young lady, whoever that person was, if you're saying you bought a house in 2019 and we were seeing, the 8 to 10% appreciation, that, let's say, $200,000 house that you maybe bought, and I think right now our average sales price is about $400,000. But if we just do sort of some quick math, let's just say the house is $200,000. So that's what we're talking about. And so you're thinking if you're getting about 8% on, say, a $200,000 home, that's roughly about $16,000. So that would mean that you bought the house for $200,000. Year 2, it's worth about $216,000, and then you add 8% to that again, and then So I think to answer that person's question, you got to look at what the appreciation is in the area, and it actually could be a pretty significant gain depending on how long you have the house. So to wrap it up in a nice, neat little bow, check in with a licensed real estate professional. They can give you a pretty good idea of where market appreciation is in your specific area, whatever state that might be. And then they'll give you a better idea of if it maybe makes sense to purchase in one area or another. Because it's one of the reasons why you and I are such big advocates of home ownership, is because of the market appreciation. And guys, if you're in the Georgia market, if you're in the Tennessee market, the Florida market, the Illinois market, where I'm licensed in, I have the ability we can talk about the average market appreciation for the area and then look at how much your rent has been going up over, let's say, the last couple of years. And we can give you a pretty good estimate and a nice, neat little graphic that shows you estimated market appreciation versus how much your rent maybe increases. And then you can see in 5 years, 7 years, where you might be on home value versus where you might be on a rent. And every single time we do that, we always see where people over like a 5 to 7 year period, if they were to sell, they end up paying less in mortgage than they would in rent. And then, of course, you have that equity piece because of the appreciation and the money that you're paying.
And I think that also ties into what we talked about in our previous episode, where a lot of people think because they're renting, they can't afford to buy a home. Or if I buy a home, the mortgage is going to be more than my rent. Or
it might be the first year.
My credit isn't going to qualify.
Right.
But it turns out in a lot of instances, not in all, I'm not going to say that this is a one-size-fits-all scenario, but in a lot of instances, you'll see paying a mortgage is less than paying your rent. Getting approved for a loan is a lot easier than you thought it was, because there are a lot of misconceptions and education on credit, what's needed for it. There's just a lot of research.
So you're saying you don't need to have a 750 credit score to buy a house?
No, I heard recently you only need a 580 credit score, which I will say again, with a 580 credit score, you can be approved for a home, but you can't get approved for a Discover card. Think about that.
Yeah, me and the compliance people are not about to get in trouble on this podcast, but if you all have questions about where your credit score is, I'm happy.
Ruffle some feathers, rattle some cages. Let's get into a little bit of trouble. Come on, let's disrupt this. This clean cut.
No.
All right. Well,
sir, if you have questions about your credit score, how much you may or may not be approved for, guys, I'm more than happy to chat with you. Hop in my DMs so we could have a virtual conversation or meet in person and talk about your situation. We do have the ability to take a peek at a credit report and provide an analysis for you to let you know maybe if there are some things that you could do if you were to amend some credit card balances or some other things we can look at. And again, everybody's situation is going to be different. So more than anything, let's get with a real estate professional, get with a mortgage professional such as myself, and we'll be happy to walk you through that. So if you were thinking like, oh, I think I want to buy a house, I'm about to sign this 12-month lease, let's chat when you sign that 12-month lease. So that way we can put you in the best possible position. So if you need to save. If things with the credit needs to be amended, let's get those things amended. But let's start sooner rather than later, as opposed to, calling me when your lease is going to be up in 45 days and you're like, ooh, I think I want to buy a house.
Yeah, you need to research and you need to plan ahead. And on the credit tip, I partner with some credit professionals. One of them at Dr. Goody, find her on Instagram. She's amazing, where she will work with you on identifying the things that you need to change and working with you on making those changes. Some people think they're like, I gotta have everything removed or I gotta have everything. No, you don't. But this is why we're here, to educate you. But also on the other side of it, it's always good to do some investigating. It's always good to do some research when it comes to making a huge purchase like buying a home, because it could be and like I said, in a lot of instances, it is easier, more accessible than you had thought. So again, research. And if you are entering into a lease right now and like, hey, I got some missed payments and stuff like that, great. If it's an 8-month lease, 9-month lease, 12-month lease, use that time to fix. Don't wait till your lease is almost up and go like, oh, I want to buy a house, I need to start working on. No, do that now. I mean, give yourself some runway, because you may find out that, oh, all I needed was like 90 days and everything's kosher. Well, great. Do you know how long on average it takes for someone to find a home? Especially when we're going into the summer months, when it's very, very crowded and competitive in the market. Do you know on average how long it takes?
I am sure you're going to enlighten us.
darn skippy.
I would say for me, most of my clients, it's anywhere from 6 weeks to maybe up to 3 months in some cases.
I tell my clients, allow yourself 3 to 8 months. Harvey, that's a 5-month gap. Oh my gosh, that's not a very good. Everybody's situation's different.
Sure.
Everybody's situation's different. My last closing, 5 months. Wonder why it was 5 months? Yeah, he had 3.5 months left on his lease, and then it took us about a month and a half to find his place, and then another month to close. So
sometimes my customers do get lucky. I've seen some borrowers, like, I get them pre-approved, and like the next week they're like, oh, we're under contract.
That's great. And God bless those people that are.
Sure.
But 99.9% of the people need to think that they are the exception and not the rule, or the rule and not the exception, I should say.
And by the way, guys, just on the credit tip, just right quick, on the FICO score, which is what us mortgage professionals use when we're looking to get you approved, 35% of that score is going to be based on your payment history. So you're going to make sure that you are paying your bills on time. And then 30% of that FICO score is going to be your utilization. So for the record, it's not good to just be making the monthly minimum. So you don't want to have a $5,000 credit card and be, your balance is $4,500 and you're making the minimum and you think that you're doing well. Having a utilization that high is not helping your credit score.
Nope.
And then 15% is based on customer history. So how long have you had the accounts? 10% is types of credit used, and then another 10% is the amount of consumers' new credit.
Yeah. So we're talking about overall payment history, total amount of credit available to you, your mix of credit. So auto loan, student loans, credit cards, any other type of revolving credit, and then the average life, or sometimes they'll do the total average life of all of your open credit accounts. So that's everything on, like, what is the overall age of that? The older they are, and
the reasons why you probably shouldn't close out some of those cards. Like, if you got that old Navy card that you've had
since college or whatever,
keep the Macy's, keep the old Navy card. Don't go closing anything until we talk.
Yes. I mean, there are some caveats to that, which I'm not going to get into because we are no way financial advisors or anything like that. But there are instances where you may need to close those accounts.
Just pay your bills, man.
If it's not working for you, but pay your bills. And the one thing I'll say, though, is a lot of people, I've had a lot of people, well, I looked on Credit Karma and it says that Credit Karma is great, but Credit Karma goes off of what's called a Vantage score.
Correct.
And a Vantage score, because what will happen is someone go like, I went to my FICO and I went to Credit Karma and all my scores are like 25 points off. Why? It's a different scoring model with the Vantage score against the FICO score. And you've heard Bryant say, we look at your FICO score. I think it's FICO 8 is the current one that all of lending institutions look at. So when they pull your credit, they're looking at your FICO score, not your Vantage score. So myfico.com is a great resource if you want to see what Bryant will see.
My FICO, actually, they have an actual mortgage score.
Yeah.
That's one of the options.
Yeah, there's a mortgage score, there's an auto loan score.
Right.
Yeah, they break it down, but it's very, very important that something as subtle as this can mess up someone's education, right? Because the average person just doesn't know. They just see,
or it could be the difference. I mean, if you think that your score, the Vantage score, let's just say the Vantage score is at a 720, but
your FICO score is 680,
is maybe at let's say 675.
Okay,
it might at that point. A 720 versus a 675, maybe we need to do a different loan program for you now.
Right.
That could be, or maybe that disqualifies you from down payment assistance.
Yeah.
Or something, or maybe a debt to income ratio. Like it could make it.
It can
35
totally
points
change the whole landscape of what your loan options are.
Right.
If any. I don't know.
Exactly.
It really, really depends. So, education is key, and that's why we're here. We want to embolden you to go out and use those resources. Like I said, at Dr. Goody on Instagram, she is incredible. She's a great resource if you want to learn more about your credit. If you need to fix your credit, she can work with you on getting all of those things set up. You can reach out to me directly. You can reach out to Bryant directly. You can comment here on the show, in the show comments, for any information you're looking for and resources. We're happy to point you out into the right direction. But if you're looking to buy a home, whether you're a first-time home buyer or not, especially for those that maybe have purchased 1 or 2 homes in the past, you know that it takes time to kind of get to the point of seeing a home and then putting in an offer and then getting to the closing table. So if you're kind of in that 6 to 12 month window, start looking now. Start working on your credit now, because you definitely want to make sure that everything is in place when you get in contact with Brian and he's ready to give you your mortgage options. And you want to be in a position where you can get the lowest score possible. And all of that is earned now. All of that is earned before you meet Bryant. So do yourself a favor, do that. I'm going to do us a favor and round this show up, because I feel like we've jam-packed a lot of info. Yeah, I think we should just let them kind of marinate on that. So
right quick before we peace out. So I looked at Vantage score. That was what I was fooling with my phone over here, but I looked at the Vantage score percentages. So remember with the FICO score, y'all, 35% of that score is going to be based on payment history. With the Vantage score, the amount of consumer recent credit is 30%. The payment history is only 28% instead of 35%. The utilization, instead of being 30% on FICO, is 23% on Vantage. And then 9% is size of consumer account balances, 9% is depth of consumer credit, and 1% is the amount of consumer available credit. So guys, some noticeable differences where you can now see why.
Same criteria, just a different model as far as how everything's weighted. Exactly.
Yeah, so that's where, so guys, if you're always wondering, like, why does Credit Karma seem inaccurate, or why is there a 30-point, 40-point variance? That's why. It's because they're weighting certain things more, they have a different way to it. So for us on the FICO side, we want to make sure you're paying your bills and your utilizations are lower. I guarantee you, if your credit card utilization is really high, let's say it's above 80%, I guarantee you, if you were to say get it, like, do an experiment, y'all. Like let's say you got a $5,000 credit card and it's at $4,800. If you can, if you're in a position where you can pay it down to 50%, see how your credit score responds. But I usually
know what the recommended utilization percentage is?
It is below. It is 30% or below. But what I find with our customers when I run those credit analysis is that actually you maximize your credit score at below 10%. Between that 1 and 10% is where you maximize it. So just imagine, y'all, if you've been riding that credit card at $4,800 on a $5,000 limit for the last year and a half, and all of a sudden you pay that thing down to $500, and you're like, oh wow, like my credit score just shot up 30 points. Well, that's why.
Or more.
Yeah.
Or more.
I'm gonna go conservative. I don't want anybody coming back at me in the comments like, why are you saying my credit score's on book like 50 points? No.
It's okay. I already gave the disclaimer. We are not making any type of financial advice. We're not financial professionals, but these are things that we've seen in real life with real clients. So we just want to pass it on to you. So take with it what you like, leave what you don't, but you can't say it wasn't given to you.
What Harvey said.
What I said. Yep. I'll also say thanks so much for watching. Go ahead, let the people know where they can find you out there on the interwebs. We do this at the end of every show. Come on.
I mean, well, hopefully you might find me on the golf course. Shout out to Eastside Golf. But guys, you can always find me on Instagram at Mortgage Pilot. Hop in my DMs. Love to hear some feedback on the pod, and if you have questions. But you can always find me flying your friendly neighborhood mortgage guys at Mortgage Pilot on Instagram.
Like I said, have those little baggies handy just in case there's any turbulence. I feel like there's always something that happens when you're trying to get to the closing table. There's always something.
Is why you always hear me tell the clients, I need all these documents up front. You've seen that email, the things that I asked for. We don't like turbulence at all.
Yep.
The only, no.
And some people just have weak stomachs. I'm just saying.
Yeah, I mean, the only turbulence we like is like if you maybe like, I don't know, frying up some chicken or it's a fish fry. Like you got to shake up the batter. But outside of that, no turbulence. We don't like that. No.
I'm just going to continue on. You can find me on Instagram at Harvey Worlds. We need Dog to just like lower third because I feel like, they don't know.
You've never done a Friday fish fry?
I've done a fish fry. I don't know if it was on Friday. My wife and I were in Jamaica.
Okay. So do you do the spaghetti with the fish?
We should say bye to the people. We could probably talk about this.
Hey, y'all, look. We appreciate you. Be sure to like, share, subscribe.
Talk to us, comment. Let us help you, listen to you. Just talk to us, engage with us. We want to hear from you, and definitely subscribe to the channel. You got to subscribe so next time we do this.
Yeah,
you'll
good job.
All right, later.
See you.